Welcome to a spring 2020 401k checkup presented by TrustPoint. I'm Kurt Siegel. I'll be your host. Now, in light of the extreme volatility that we've experienced recently, it seems like a good time to examine some of the effects of the COVID pandemic on markets, on your 401k, and what responses might be to this, both yours and ours. So let's begin by taking inventory. Now, first and foremost, taking care of yourself and your family is extremely important. Everyone has been asked to make great sacrifices and changes in their lives. Financials, of course, are one thing, but taking care of yourself emotionally and your health is really important. Now, work disruptions have been common to most everyone. Maybe you're working at the workplace, but surrounded by fewer of your colleagues. Maybe you're working from home with the interruptions and distractions that come from that, or possibly furloughed. Some have taken pay cuts or been laid off. By now, you've had time to consider the impact and ramifications on yourself and on your family, and you're making adjustments. So shortly, we're going to talk about some of the financial impacts in more detail and what steps might be taken or might need to be taken. Now, certainly this financial shock that we're experiencing feels very different than others when you think about it. And it feels like maybe we've never been here before. And in a sense, that's true. This financial crisis, if you will, has been driven by a medical situation and by the fact that individuals have been asked to not go to work and to close down businesses. So it's not your typical recession by any means. You can see a list of what are more common causes of recessions on the slide. They're financially driven and not health driven. But there is one similarity between this recession and every other that we've had in the past and every other financial crisis, and that's that we've always gotten through them, and we'll get through this one as well. Now, let's take a look at what downturns in stock markets look like and the impact on stock prices and 401k balances. It's very common to have a 5 or 10% drop in the price of stocks. Drawdowns of 15 to 20% are much less common, but they do happen on average about every 6 or 7 years. The most recent recession and drawdown of more than 20% was about 11 years ago, the last time we had a recession. Now, this slide illustrates how markets have behaved following the bottoming process of stock prices. For example, on the left side, an investor who stayed in and stayed invested in the market throughout the volatility, after 1 year, had an approximately better than a 60% average recovery in stock prices. And after 2 years, a cumulative 90%, and after 3 years, more than 100% on average. That's what it typically looks like after the bottoming prices, after the bottoming process. Now, importantly, what stands out is that missing even that first month of recovery, which is about 22 trading days, that cuts the rate of returns in the first, second, and third years literally in half from what they would have been had one stayed in. And 3 months on the front end, missing 3 months or 6 months of that recovery is even more extreme. Now, taking a look at some of the relatively recent recessions and market declines, going back to the mid-90s, there have been several. And if you focus on the third column, the peak to trough decline, you'll see that the declines are typically 20% or more in a recession, and that the last or most recent two recessions were a couple of the worst. Now, toward the bottom, the peak decline in the peak to trough decline on average is about 30%. This time it was about 34%, and we've recovered most of that relatively quickly. We don't know yet what the 1-year average return will, or what the 1-year return from the bottom will be, or what the 5-year average return will be. But you can see the average annual 5-year returns off a bottom in stock prices is about 19% a year, which is really a terrific rate of return. So we don't know when this is going to end. We don't know if we'll have a second wave of infections, which could cause further volatility in the stock market. So we'll just have to wait and see. Now, let's think about what steps one might take in regard to all of this volatility. Now, stepping back for just a second, let's remember that investment returns are tied to the type of investments we make. We have two choices in the 401k, stocks or bonds. Stocks generally have had the higher rate of return over time. So looking at the bottom left-hand corner of this chart, it indicates that a fixed income, or what is otherwise known as a bond portfolio, is going to have the lowest expected return, but also the least volatility or risk associated with that portfolio. And as you move out to the right, successively, stock exposure, additional stock exposure is added, and the result is a higher expected rate of return with each addition of stocks and a greater level of risk or volatility. You cannot disassociate those. Now, the choices that you have in your 401k are really divided into two broad categories using stocks and bonds. The first is what is known as a target date fund. In that, you select the target date fund with the date most closely associated or corresponding to your expected retirement date. Or if you choose not to use your retirement date, then that would be corresponding to your risk tolerance level. I'll show you an illustration of this in a moment. But the object of this is, if you've picked your target date, as time passes, stocks are replaced gradually with bonds to reduce the risk as you approach retirement date. And it's all done for you. Therefore, we call this the do it for me option. It's all automatic. Now, the other alternative is to select from a list of individual mutual funds. We call this the do-it-yourself method. You put together your own portfolio, choosing those mutual funds from many different types and objectives of both stocks and bonds, knowing that TrustPoint, the investment team at TrustPoint, has selected those carefully and continues to monitor those mutual funds for their performance and their relative risk and return history. Now, most people who use select individual mutual funds know something about those mutual funds, keep up with them, or rely on a trusted advisor to help them with that. So this is an illustration of the target date fund. It's age-based. For example, if your expected retirement date were about 26 years into the future, about the year 2045 or 2046, you would likely pick the target date fund in the middle of this chart with 26 years until retirement. And all of the target dates to the left, which are longer in duration, look similar in investment composition. The green and the yellow portions of the bar charts represent stocks, domestic in the case of green and international stocks in the yellow. And they cumulatively are 90% of the portfolio or even a little bit more, and the remainder being bonds. And you can see what happens over time as you move closer to your targeted retirement date. The adjustments will made. The target date fund is based on the principle that greater risk and return expectations are most appropriate when you're several years away from retirement. Therefore, the greater exposure to stock. Then as you age and you get closer to retirement, the fund becomes more conservative by replacing stocks with bonds. And again, it's all done automatically. So that's the way the target date fund operates. If, for example, you had other outside assets, or for some reason your objectives didn't fit with this, for instance, as you get close to retirement, you could switch into a different target date fund and become more aggressive if you had more conservative assets outside the 401k, for example. So there's flexibility in this. But if this is your primary asset for retirement, it automatically takes care of the asset allocation changes. Okay, now let's think for a minute about this volatility that has occurred, and if it were to occur again, if we were to have a second wave of infections, that may impact stock prices and they may become volatile again. Now, this illustration is a hypothetical look at two types of investors. Everybody's different when it comes to dealing with the risk and volatility of our own money. So this is a look at kind of the opposite extremes of the spectrum. In the case of the blue chart, it represents an opportunistic investor, and the orange chart, a more apprehensive investor. They both, in this example, started with $10,000 in the stock market back at the beginning of 1978. And the dots, the dot pairings represent the point in which the stock market dropped 8% in a given month. And the two investors had different reactions or took different approaches to this. There are about 14 pairs of dots on this. And if we extended the chart to present day, there'd be a couple more. But what happens in this is that every time the stock market dropped 8%, the opportunistic investor added $2,000 to his or her stock portfolio. And every time the stock market dropped 8%, the apprehensive investor at the same time withdrew $2,000 out of stocks and put it into a very safe 30-day treasury bill investment, probably because of the uncertainty facing what was going on with the economy and the stock market and how much worse it might get. The apprehensive investor took the step to be more cautious. And you see the end result. There's a huge disparity between the two tactics that these hypothetical investors took. And the investor who just stayed invested and didn't add or subtract from his or her balances would be somewhere in the middle. But the point of this chart is that each and every time stocks have dropped significantly and dramatically, it's been a benefit actually to stay invested or even add money during those periods of times. It's always worked out in the past. Let's think about steps you might consider or decisions you might make with respect to the volatility, and particularly if it were to recur. One would be to stay put and ride it out. If you have time, if your objectives have not changed, then it wouldn't necessarily be uh, it wouldn't be necessarily incorrect to just stay the duration of any future volatility, assuming you don't need the money in the short term. Statistics, as I tried to show you in previous slides, illustrate that this eventually works out. Now, another reaction might be, if you're going to need money from these accounts in the future, in the foreseeable future, you may want to build a bit of a cash fund in the form of a money market or very short-term bond account. And those are available within the selection of mutual funds. You can peel off or transfer a portion of a target date fund or otherwise into a cash fund if you foresee using that in retirement, for example, in the foreseeable few years. And the thought process along that line would be, even if we have recurring volatility in the stock market and associated with more risk returning, then you're not going to spend all your money all at once in retirement, and you'd have a cash reserve available to draw on if you needed it, and if you needed to wait for the assets to recover any drawdowns that might have occurred in the future. I think it's a good idea to have some cash reserves in that safe form heading into retirement just for that reason. Now, you also might change your investment allocation to stocks and bonds. We don't recommend trying to time the market. It's proven to be a futile exercise. But one might decide that he or she could become more aggressive or has wanted to be more aggressive. When stock prices are down, that's the best time to do that, to actually add, like our opportunistic investor, to add to your risk assets in the form of more stocks. Or if your objectives have changed, then that would be another reason to adjust your allocation to stocks or bonds. All right, now while you're doing this and considering these things, TrustPoint, as I mentioned earlier, is continuously monitoring the mutual fund managers. We're looking for signs of any variance from what would be expected from them. It is only occasionally that we find a need to remove and replace a fund, but we would do that if conditions warranted. We also are trying to communicate with you through webinars like this, as well as other webinars with similar, addressing similar information, and broadly so, that are posted on our website. So do feel free to visit our website periodically to become updated. Now, as a 401k investor, you're in a unique situation. You're automatically taking advantage of what we call dollar cost averaging by contributing every payroll to your investments. You are investing the same amount of money, approximately, every payroll period. And what this hypothetical example shows is the systematic investing, as a 401k investor does, every month. This example shows $1,000 per month being invested in stock. It doesn't matter what dollar amount, it still is going to work, whether it's $1,000 or $100 a month. So in this example, that $1,000 at the beginning of the year in January, with stock prices valued hypothetically at $25 a share, $1,000 would buy 40 shares. And as stock prices diminish or drop through the spring and into the summer, that $1,000 buys more shares. It buys 50 shares and then more than 60 shares as stock prices get lower and lower. And when the recovery occurs in the fall and early winter, the outcome or the result of this is that the average cost the investor paid was, rather than nearly $25 a share, the average cost was $19.44 a share. And by the time stock prices recovered, that resulted in about a 30% profit. So investing systematically can help you achieve a better outcome when markets are volatile and there's actually, blue sky. There's a silver lining in all of this volatility. Okay, now we're going to assess this from a little bit different standpoint, because the impact of all of the volatility and the disruptions that have occurred in our economy and in our workplaces has had varying impact on individuals. And this slide attempts to break down this into two categories: those individuals who have been impacted in a moderate to severe way, where their income has been reduced or maybe lost entirely during this period of time. The asset values in the 401k have been eroded, and the presumption is, because of the loss of household income, they're likely to be needed. So that would be a moderate to severe impact. Another category would be a mild to no impact. Household income has remained stable. There's no effect so far. Asset values, however, similarly have been eroded, 401k assets and others, but they're presumed not to be needed. Let's talk about things to consider or potentially do. There are a lot of them. So in the mild to no impact, to be in that fortunate situation, what we become aware of is that these are exactly the kind of times that we may need an emergency fund. And if we don't have one, it's a great time to build one up or to add to it. It's also a good time, most people spend less when they're not out doing things, when we have had this stay at home and social distancing requirement. So we tend to spend less. It's a great time to eliminate high interest rate debt. It is also a good time to just kind of think about what your financial objectives are, both short term and longer term, for example, for retirement, and just see if there have been any changes. And this would be a good time not only to evaluate that, but maybe to implement changes if your objectives have changed. Rebalancing, as stocks have become a lower percentage of your portfolio during a period of stock market decline, you may want to reallocate some of the bond money into stocks if you're using the do-it-yourself method. Now remember, the target date fund rebalances all of that for you automatically. But if you're doing it yourself, you may want to reallocate some money. Some individuals who are of an age where required minimum distribution is required of them from a 401k or an IRA under the CARES Relief Act, which was signed in March, can forgo taking that, or even if they have taken it, roll it back into an IRA and not have to utilize that this year. That's a one-time opportunity. One opportunistically might increase contributions to a 401k during periods of decline, just as the opportunistic investor did, and adding more money. In that case, it was $2,000 when markets dropped. As more value is perceived to be created, then it's a good time to actually increase contributions. Review any philanthropic objectives that you may have and see if the pandemic has changed things in that direction. It's a great time to kind of look at things holistically again. That would be indicative of a little broader, holistic review, financial review, than just looking at your retirement objectives or short-term goals, that sort of thing. You can look at the whole thing, and in periods of disruption, it's oftentimes a trigger point. And by all means, with the monies that you are able to spend and need to spend, the local economy certainly needs it. Our local economies need that, and try and spend where you can to support your local merchants. Now, for those who might be more severely impacted, this is the time that we would want to, and whether it's you or someone close to you, maybe a family member or some dependent, it's a great time to be sure to focus on needs versus wants. Just kind of differentiate between those two. Then the CARES Act has had many different actions have been taken to try and help people get through this period of time. A number of postponements options have been made available. For example, major banks have instituted 3-month delays on the payments of such things as auto loans and mortgages and lease payments on cars, home equity loans, even credit card payments can be delayed for a period of time. So it's worthwhile exploring those opportunities. Cash and credit, you know, if the emergency fund is insufficient, then it may be necessary to seek out the lowest cost loan possibilities. For those with equity in their home, a home equity loan would probably be the lowest cost. If need be, to get through this period, you know, maybe even seeking a loan from family members might be necessary. Okay, so with respect specifically to the 401k, you can make reductions in your contributions quickly and easily by going to the website and either making the change if offered on the website or printing the form that would allow you to change your deferral percentage. It's all on the 401k website under forms. The form, if you use the printed form, would go through HR. Bear in mind that if you do reduce your contributions, maybe eliminate them temporarily, you also may be losing any match that the company may be making alongside the dollars you have been contributing. There is the loss of the potential to buy low when stock prices are low, that dollar cost averaging, and all of that results in a possible loss of future opportunity and growth. But if it's necessary, that's what it's there for, to either decrease your contributions, eliminate them, and it's just as flexible to add them back when your income returns or when your situation improves. With respect to 401k and IRA withdrawals, if you are forced to take a withdrawal, then the income taxes due have been stretched out to be paid over a period of as long as 3 years under the CARES Act. In so doing and taking out withdrawals, you know, the risk is you might be taking out at a low point in stock prices rather than when they're high. There's a possible loss of future opportunities, and it just makes it more difficult to ever get back to even as you put money back in. It just makes it more difficult if that money hasn't been there. And again, it's a good time to review your objectives. If they've not changed, if your time frame for retirement hasn't changed, then it probably isn't necessary to change your investment objectives either. Okay, staying the course. Let's just, we've talked about this in different ways, but let's just take a look at this illustration. This illustrates the stock market during the financial crisis, which began at the end of 2007. The dark gray shaded area represents a recessionary period in the economy. And so from the peak in stock prices in November of 2007 to the low point in March of 2009, that was a 16-month period. Stocks dropped approximately 45 to 50% of their value, even more than they have this time. And then a recovery began, and stock prices returned to their peak prices in about the first quarter of 2012. So from November of 2007 to the bottom of in March of 09 to a return in similar value in March of 2012. It's about a 4.5-year cycle. It was deeper than most. The financial crisis was the worst we'd had going back generations, and it was about a 4.5-year period of time. And then you see the resumption of stock market returns with some choppiness along the way, but to some very significant new highs. Now, that's all represented by the light blue line. The dark blue line represents an individual who might have reacted to the volatility at or near the low point and gotten out of stocks and stayed out for a period of 12 years, and then found the nerve to re-enter as stock prices were recovering after 12 months of being out. And of course, that portfolio never catches up. And the green line would be the individual who got out near the bottom and just stayed out and put money into a safe money market fund with no chance of getting back those returns. Now, this is the classic stocks, bonds, and treasury bill chart in relation to inflation over time. It's just a classic chart that's used by investors for decades. Now, at the bottom left, the indexes begin in 1926, and in the ensuing years, and by the way, these indexes begin at $1 in value, each of them. The indexes represent small stocks, large stocks, government bonds, treasury bills, and then the gray portion is the rate of inflation. Now, these markets experienced a depression or two, recessions, wars, double-digit inflation, deflation, oil price shocks, all of those things, and yet still, over time, they had very significant healthy rates of return on average, with lots of periods of volatility. So when we subject ourselves to stocks for their greater expected returns, we have to be willing to accept the volatility that comes with them relative to the lower volatility and lower returns of, for instance, bonds, as represented here by the gray line. And treasury bills, what is considered kind of the riskless investment in T-bills, US T-bills, or money market funds, you can see that the rates of return barely exceed the rate of inflation over time. So I just show you this to keep this in mind, keep this perspective when things are volatile. It is difficult at times to remain invested, but if we can kind of revert back to the perspective of some of these slides, it may be a bit easier to maintain our nerve and stay with the investments. Now, the last couple things I want to say is that there are some great resources on the website. If you sign into the website, there is a tab that's called the Financial Resource Center. And it's chock full of great articles and good ideas and calculators to help you figure out what your objectives might be and how to meet them. This is all arranged by age category, age groups, but don't hesitate to wander amongst those age groups. There's lots of good material and overlapping material that I've found outside my age category, and I encourage you to explore these. They're have proven to be very useful. Now, on this slide, this is our most recent addition to the website, and it's called My Retirement. And the My Retirement tool is on that dashboard now with a button at the bottom or a tab at the bottom called My Retirement Analysis. Now, the purpose of this is to give you an idea, and it's a remarkably reliable idea of what the monthly income is liable to be that you're able to derive from this 401k at retirement based on the contributions you're putting in, any company contributions, the age at which you expect to retire, the lifespan you estimate you may live, and you can change these things. You can incorporate Social Security into that monthly income figure. You can incorporate spousal information if you wish, and it's all saved on this site called My Retirement Analysis. You build the information in, and you can change it accordingly. If you increase your contribution rates, you can bump that in there, and it'll have an effect. And you can kind of also play with it and see what more contributions would be, or the effect of retiring earlier, and so forth. It's a phenomenally flexible tool. And as you will see, it has a high degree of reliability because of the many considerations it gives to inflation, interest rates, and stock and economic volatility. So I encourage you to take a look at this if you haven't as well. So with that said, I want to thank you for your interest and participation in this. If you have any questions beyond what we've discussed today, if you feel you need to delve into anything a little bit deeper with an individual, or just have operational or functional questions about our website, be sure to contact the Retirement Plan Services team at the number listed on the slide. With that, I want to again thank you and say farewell until we meet again. Good day.